Hello, this is Paula White, and I am your instructor for Accounting 233 Income Tax. And it's going to be a very informative 4 weeks that you have with this subject and income tax. If you love it, it can be an awesome career. If you don't love it, then it's just one of the things you need to know about. Because accounting, remember, no matter what, accounting is a huge career that you can go into auditing or tax or financial reporting or forensic accounting or having your own bookkeeping and tax practice. You can work for a major corporation. It will take you places you have no idea of what's going to happen in the next 5, 10, 15 years. I've written tax books. I've written accounting books. I have a new book out. You can read about it in my introduction. I never thought I'd be an author, but here I am. I'm teaching. I'm loving that. I'm doing other things, but it's all accounting related. You never know where this curriculum can take you in your career, and that's the point I'm trying to make. So I'm excited for you to be at this stage of your accounting career, because if you just keep saying yes, you'll never know what's going to open up for your future. So let's get started. Give me just a second here. Let's get started. I am your instructor, and that's my picture. And I'm going to click on that. And I am a CPA. I am licensed in the state of Washington and in the state of Illinois. And I'll tell you more about my career as this class continues on. I have my MBA from Washington University in St. Louis. This is my email, paula.white@independence.edu. My cell phone number is 760-710-7841. And I'm going to have these recorded as we do them and put them up online as soon as the recording renders. So you'll always have access to the online lectures 24/7. Let's go home. And as you know, we're in the live session right now. But regardless, do not forget that you have some resources outside of the instructor. Of course, I am your resource, but you also have the Student Success Center. You click on that. I will be posting some of the tutors' flyers throughout this mod. If you click on accounting, it looks like this mod. They're available Mondays from noon to 3 and 5 to 9 Mountain Time. Tuesday, they're available 13 hours from 10 a.m. to 11 p.m. Thursday, 10 a.m. to 10 p.m. Friday from 9 to 11 p.m. 9 a.m. that means. And Saturday from 9 a.m. to noon. And if you're really stuck, they're a great source. I also want to make sure that you're aware that this is not just like some of your other accounting courses. You actually have to work to learn the material and to apply the material. You just can't slide through. So here's a table of contents of the actual textbook. And today we're supposed to cover the history of taxation, Chapter 1 and Chapter 2, the types of tax rate structures, other types of taxes, criteria for tax structure, entities, administration, components of a tax practice, computer applications in a tax practice, and I'll show you what I use. Then we have the problems in Chapter 1. We have Chapter 2, determination of the tax. What's AGI? What is the amount of tax? What do you do if you have a business income and business entities? How are they handled differently? What is this thing called capital gains? And it goes on. And that's just the first 2 chapters of this tax course. So first thing I really would suggest you do is be very friendly with the textbook, because in an hour-long lecture, I cannot physically speak on each one of these subjects. I can certainly give you an overview. I can give you some advice and some realism throughout this course, and give you some indication of information to successfully complete your homework assignments. But to go over all this information in extreme detail in an hour-long lecture, impossible. So you have to do some of the heavy lifting in this course. And in fact, when you're actually in a tax course, you're expected to do some of the heavy lifting in the learning process. So don't get scared. Let me try, and I keep having this thing come down. Let me go back to the course. Let's say week 1. Introduction and goals. Oh, good. A few more people have introduced themselves. This is the discussion, and I introduced myself on Sunday, and Tasha did yesterday, as well as Crystal. And okay, so not too many of you have introduced yourselves to me yet, so I guess you're keeping that a secret. In the meantime, week 1, we have the discussion. And we do have a discussion ongoing each and every week, except for week 4. And do not throw your points away, because at the end of the week, this is a 60-point assignment. So there's a lot of recent media coverage in the U.S. as their use in the progressive tax system. The more money you earn, the higher rate that you pay. Locate an article in the library or in Shark that focuses on this and other types of tax systems, and answer whether you feel our system is fair. What alternative methods would you propose? And be sure to cite some outside sources to support your conclusion. This is an easy way to get 60 points. The rules and regulations are right here in the discussion forum instructions. But basically, by Wednesday midnight on Mountain Time, you should have your initial post posted. I'm looking for your initial post, I'm looking for your research, and I'm looking for it to be posted by 11:59 p.m. Mountain Time. Now, before Saturday at 11:59 Mountain Time, I want you to post a response to 2 other students' posts. And I am checking the times that you post. I am checking for how many posts you do. And a post needs to be substantive. It can't be, hey, Bob, good comment. That doesn't make the conversation go any further. More like, hey, Bob, I like your position on taxation. Have you ever thought of this? And you continue it, and you can even add, if you want to, as a best practice, add some more research and move the conversation further. And for the best of the best, then you'd ask Bob a question that would continue the conversation going. Just like going to a party, you come to a party that begins at day 1 and it goes through midnight on Saturday night. What happens in Sunday or Monday after the party's over? Can you make a comment? Yeah, but no one's going to hear the comment because they're on week 2 or week 3. So no, there's no late points established on discussion forums, because when the party's over, there's no one to talk to. They all moved into the next week, and that discussion is going on. Okay, let's continue. Let's go back. So don't throw those 60 points away, please. That's discussion. Assignment 1. And it looks like in this course, you have problems from the textbook. In this case, it's problems 1-39, chapter 2, problems 39, and in chapter 2, problems 30. The first one is in chapter 1. And you do those 3 problems, and you put them, attach them in a Word or Excel file, and you attach them to, you submit them as a file. The text is written from the 2012 perspective. So right here is a 2012 tax table. Don't fret about that because the tax laws they change rates, but they don't change concepts that much. So be sure to embrace the textbook, get the concept down, and then use this tax table for these problems, and you'll be in good stand. These problems are due by midnight, 11:59 p.m. Saturday, and that's Mountain Time. I keep saying that because it is Mountain Time, and even though I'm in San Diego, that's Pacific Time. I'm an hour off, but if you're in the East Coast, you have to adhere to the Mountain Time also. So let's continue. Let's just go to the actual chapter. And I'm not going to go into extreme depth on these, but just touch base because basically there's, like I said, a lot to cover. Introducing yourself to taxation, you should just basically get that from reading the textbook. The textbook talks about the history of taxation, the types of tax rate structures, criteria for tax structure, and the objectives of federal income tax law, and the entities inside of that income tax system. Well, here's the taxation. First federal income tax occurred in 1861 after the war. It got repealed after the Civil War, got reinstated in 1894. Supreme Court ruled it unconstitutional in 1895. 16th Amendment on March 1st, 1913 came in, and then the Revenue Acts prior to codification in 1939. And right now there's over 40,000 pages of codified tax law. Tax law is the responsibility of the Congress to write. So Congress writes the law, and then when the law gets passed, it gets codified. It goes into sections of the tax law, and it is law just like every other law. There's a filing system of law, and that's codification. So you're going to be talking about section 179. You're going to be talking about subchapter S Corp, subchapter C corporations. Those are all the filing system within the codification of the law. But for federal only, it's in excess of 40,000 pages of law. So the manner in which the tax law is changed or modified, federal is changed on an incremental basis instead of a complete revision, which just means if you have 40,000 page document, how are you going to edit it? You're going to edit it piece by piece, right? You're going to do it incrementally. You're not going to take the whole 40,000 page document and rewrite it from the very first page to the 40,000th page. You're going to do it piece by piece, and that's what it means by the tax law has been referred to as a quilt work of tax law because it has a lot of patches to it. I think this is kind of interesting that the revenue sources for the federal government from 1960 through 2010 Individuals are still around 40 to 45%, but FICA, that's Social Security and Medicare, has gone from 15% to 32% to 37% to now 40% of the revenue source is coming from Social Security and Medicare. Corporate taxes are going from mid 20% down. Corporate is what? Corporate is red. Mid 20% down to 15, down to 10, until now it's lower than 10%. The question is, why? Well, take economics, look at major corporations and what's happening, look at the success of small and medium-sized businesses in the United States and make your own judgment. And other taxes are going from 17% down to 8, up to 9, and stay basically solid at 9%. So that's where the revenue is coming in for our country to run its business. Now we have individual taxes, we have corporate taxes, and I'll show you where to get all this information. But okay, basically this should make sense. A tax base is the amount which the tax rate is applied. And we'll get into the tax rates. For corporations, and this is as of 2012, the first 50,000 profit of taxable income was taxed at 15%. If it's less than 75 but greater than 50, it's 7,500 plus 25% of taxable income. But do you see the 75% is basically 15% of 50,000. And then the incremental difference between 50,000 and less than 75,000 is taxed at the 25% tax rate. Same thing with the 34% being taxed between the 75,000 and the 100,000. And 39%. So this is a progressive tax structure. And then kind of goes down to 34%. So basically, in this particular tax structure, when you hit 335,000 taxable income, then the income goes from 39% taxable down to 34% taxable. Then it goes up again to 35, 38, and then it ends at 35% taxable. But look, that's a lot of income. 10 million, 15 million, 18 million. So most of the businesses that you work for, or if they're small to medium-sized business, are in this range. So they're paying between 25% and 39% of federal taxes. The larger businesses are paying different. Okay, this is income tax. Oops, sorry. This is income tax. How taxable income is calculated for individuals. Now I'm going to take this down and go to this is my software that I use, and this is 2012. I use Drake. I'm using 2012 because it's consistent with your textbook. And I set up a new Social Security number, 222-22-2222, and I named it Independence University. So I'm just going to then show you what Control V. Hopefully I can get into the, okay, give me a second, we'll be single. Okay, it wants some dates. August first. Oh, come on. Oh, we didn't die here. August. Okay. This is not the form I want. This is the 1040 EZ. I wanted to show you a different form. So we'll do that later. And come on. I'll show you that later in the class. Meanwhile, I will go to irs.gov. That is a website you need to know about if you have any serious interest in being an accountant, in knowing taxes, or even doing taxes. irs.gov. I want to see what a 1040 looks like. And this is a 1040 for 2014 tax year. Because we're in 2015 right now, 2015 has to end before 2015 is reported to the tax system. So the most current we have now is 2014 because that ended to December 31st, 2014, and this is a year that we do 2014 taxes. But let's just look at the equation here. After your name, your social security number, then you have filing status: single, married filing separately, head of household, or are you a qualifying widower with a child? Then you have exemptions. You can have exemption for yourself and for your spouse and your dependents. Your dependents have to have their own social security number. They have to be human. They can't be your dog or cat. They have to be human. They have to be your dependents. And there's rules about special dependents, but if they're your children, they're your dependents, dependent relationship to you, and if they're under age 17, so you have that. But the actual equation for taxation, you have income, which can be wages or interest or tax-exempt interest, dividends, alimony, business income. That's a self-employment type person. IRA distributions, pensions, annuities, rental real estate. Do you get Social Security benefits, other income? So that all adds down to total income. And then you have adjusted gross income. So this income, line 22, drops down to line 37 with these adjustments. Are you an educator? If you are, then you can take some off because you teach grade school. Certain business expenses of reservists, performing artists, or fee-based government officials. You have some certain business expenses you can take off here. Your health savings account, moving expenses under certain conditions. A self-employed simple employment plan, simple qualified plans. All of these are subtractions to your total income to get to AGI. This is a very important line, and it's something in our language that we speak as tax professionals. This is adjusted gross income, AGI. Now let's go to page 2. Given this is the last line of page 1, it's easy just to put it as the first line of page 2 because this is AGI. Now, remember, AGI was after some of those special deductions. Now, were you born before 1950, or are you blind? So this kind of indicates what your exemptions are, your special exemptions. Then you can have an itemized deduction or a standard deduction. Many times, many people are in a standard deduction, and they take the standard deduction. For 2014, the standard deduction for single or married filing separately was $6,200. So if you just say, oh, I'll just take the standard deduction, then you get to take $6,200 off of your AGI to come down to taxable income. Taxable income is line 43. So itemized deductions, but if you're itemizing deductions, then you can take off a lot more if you have those type of expenses to take advantage of. However, if the itemized deductions do not exceed $6,200 for single, and you are single, if they don't exceed it, then why do you have to take it? You take the standard deduction instead, because the standard deduction of $6,200 would benefit you greater than your actual expenses in a Schedule A itemized deduction of $5,200. I would rather take $6,200 off taxable income than $5,200. So that's a decision there. What are your itemized deductions? A lot of times, usually if you are a homeowner or just bought a house, you can pretty much qualify for itemized deductions because of home interest and other such taxes relating to the house. Exemptions, if line 38, which is AGI, if it's less than $152,000, your exemption in 2014 would be $3,950 times the number in line 6D. Where is line 6D? 6D is right here. Remember when we listed yourself and your spouse and your dependents? This number right here is 6D. So if you have 4 kids, yourself and your spouse, you have 6 exemptions. So for each exemption, you can take off in 2014 $3,950 for each of those folks. So the multiplication of 6 times, that's $4,000 closely. 6 times 4,000 is what, $24,000? So just by having your dependents, you can take off, in this example, $24,000 off of your AGI to get to taxable income. So say your AGI isn't your taxable income. You have some major hitters here to reduce your AGI down to your taxable income. And then you have the tax on that taxable income. And so to this date, you have deductions to your AGI. Now we're going to talk about credits. Credits are better than deductions because deductions reduce the amount of taxable income that then gets taxed. Credits are after you calculate your tax. These are credits off the total balance of your tax that you have. So you have education tax credits, you have child care tax credits, you have additional child care tax credits, and then you have some additional taxes that you have to pay in some cases, and then finally you get to, okay, this is your total tax in line 63 minus your federal income tax that was withheld from your W-2, your paychecks, and your 1099s. And some other tax credits. So basically, it is your total tax minus your withholdings of what you paid in throughout the year will get you either the amount that you overpaid and therefore can have a refund, or the amount that you underpaid and you owe. So basically, this is the 1040. I don't know if you've ever seen this before. Depends on your own personal perspective. A lot of times you may have had access to the 1040 EZ or 1040 EZ, which is a simplified version of this. But this is the full-blown version. So income minus adjustments will get you AGI. AGI minus your itemized deductions or your standard deduction will get you minus your exemptions will get you your taxable income. Taxable income times the tax rate will get you tax, minus tax credits will get you what you owe, your total tax burden, less the taxes that you paid in will get you either the situation that you overpaid, therefore you get a refund, or that you underpaid and you have to pay more in. So this is a tax return form that we're going to be dealing with for individuals in this class. So let's go back. And this is what I said from the current slide. Okay. So here, gross income minus deductions for AGI, get your AGI minus deductions, get your taxable. We just went through that, except showing you the actual form. It's exactly what I showed you. Then you have state and local taxes, welfare transfer taxes. There's a gift tax, there's an estate tax, there's property, excise, sales tax, and employment taxes. So if you're just knowledgeable on income tax because you have to file them, the world of a professional tax person is much broader than just your personal income tax business. Okay. I think this is kind of interesting. Businesses spent $148 billion to comply with federal tax law. That means they pay people like us that much, or attorneys to get them some additional help, and $80 billion to comply with state and local taxes. Individuals paid $111 billion. That's H&R Block. That's you as a tax professional. That's CPA firms. Okay, let's speed through here because I don't want to. Short shift you on the actual homework assignment. Okay. Also, we have flow through, and you have corporations. Okay, tax-paying entities. Let's stay here. We have individuals, you and I. We earn some money, our wages, our salaries, or a 1099 if we're an independent contractor. Also, there are C corporations. Those are major corporations with more than 100 owners. And these are corporations that you see on a good example of a C corporation would be every company that is on the stock exchange has to, by definition, be a C corp. By definition, they have more than 100 owners. So every corporation that is on the New York Stock Exchange, the American Stock Exchange, any of the stock exchanges have to be a C corporation if they're a U.S. company. Then we have trusts, and okay, let's go back to C corporations. I want to make one thing plain. Double taxation. A C corporation has to pay taxes on its own income. Then you own stock in the C corporation. It could be, oh my gosh, it could be Netflix stock that you own. And Netflix has to be a C corporation because there's more than 100 owners, and they therefore have to be a C corp. Any profit that they make, net income, has to be taxed, and the corporation as a C corporation has to pay its own tax. Then they pay the owners dividends, quarterly dividends. They pay each of us who own stock. They pay us a dividend payment. By January 31st, you, as a recipient of the dividend, get a 1099-DIV at the end of January that reports how many dividends they paid you throughout that tax year. And they report that to the IRS, and they report that to you. So you get to now put that into your own personal income tax return, your personal 1040. These are dividends made after tax. If you remember your accounting courses, you have the statement of retained earnings, which is beginning balance plus net income minus dividends to get you ending retained earnings. Well, net income has been reduced by taxes. So your dividends at that state are after taxes have been taken out and paid. So fast forward to income tax. So you get to now include your dividends that you got from Netflix on your personal tax return, which will be increasing your taxable income, your AGI, and your tax that you have to pay. You're the owner. You're one of the owners of Netflix. Didn't Netflix pay tax on their income? And now you're paying tax on income a second time. That's double taxation. On the same income base, you as owners of the company have paid income tax twice. So let's fast forward to flow-through entities. We have the sole proprietorship, which is not a corporation. You can wake up today or wake up tomorrow and go, I think I want to be in business for myself. And you get a checking account for the business, you get some business cards, and you start doing the business. That's a sole proprietorship. They're also called Schedule C businesses because it's Schedule C within the tax forms. You and I can determine to have a partnership. We can say, hey, wouldn't it be cool to have a consulting business? We shake hands on it, and we have a partnership. We also have LLCs, LLPs, and S corporations. S corporations are kind of cool because several decades ago, Congress decided to give small businesses a chance to be corporations, but without the double taxation. So if you have less than 100 stockholders, and all those stockholders are U.S. citizens and individuals, not other corporations, you can have a subchapter S corporation. This means that you have sales minus all your expenses to come down to taxable income. On that tax return, it's in tax return 1120S. That tax return with the taxable income, that taxable income gets spread between all of the owners of stock in that corporation proportionately to the total. If I own 10% of the stock to total stock outstanding, then I get 10% of that taxable income, and that's reported to me and the IRS through a form called the K-1. Form K-1 has my name, my address, my social security number, and my share of income. That share of income gets put onto my 1040 tax return, and I get to pay taxes on that 1/10 of the income of my sole proprietorship. The sole proprietorship tax return just goes down to taxable income. There's no taxes paid federally at that stage. So the double taxation has been removed. LLCs are a state entity as well as LLPs, and an LLC can be taxed as an individual. If you are the only member of the LLC, you can say, hey, just tax it as a sole proprietorship. You can say, I want to be taxed as a C Corp. I can tax it as an S Corp, or I could tax it as a partnership. you make that choice as members of that LLC. Okay, this is information you can read from the book. This is important to know. The general rule is 3 years from the latter of the date the tax return was filed or the due date. That's a statute of limitations. So if you filed your 1040 tax return in today, which is September the 8th, 2015, the 2014 tax return is open for 3 years. So from September 8th, 2015, 16, 17, 18. So the IRS can amend it and you can amend it until September 8th, 2018. If you wait until the day after, then it will not be processed. The statute of limitations is over. Except if it's fraud, and it can be indefinite. So you don't want fraudulent stuff. Components of a tax practice. If you're really serious about going into taxes, you need to know about compliance and procedure. You need to have some resources at your fingertips for tax research. And throughout time, I'm going to show you some of the stuff that I've been using. The fun part of a tax practice is tax planning and consulting on taxes. And that also leads into financial planning. The tax compliance is essentially preparing the tax returns and getting them prepared and submitted by the deadlines. But the fun part to me is the tax research, planning, consulting, and financial planning. What you're going to do in this business and what you're going to do personally to live the life and have the business that you want to have. So you do use computer applications in taxes. I would not have ever gone into taxes if I didn't have a computer. Preparation software, there's tax planning applications. You can project depreciation instead of actually having to calculate it manually. You have RIA Checkpoint, which is a tax research, CCH, Tax Research Network, and the IRS website. I showed you a little bit about the IRS website when I showed you the 1040 tax form. Let me show you one more thing about the IRS. This is the landing page. It's just irs.gov. This is an excellent resource. They have forms and pubs, and I just want income tax. Publication 17, your federal income tax. That, I'm going to get it down, show you just how easy it is. Current products, it's a PDF, it's an HTML, or it's an ebook. I'm going to bring it down as an HTML. And it has everything, almost everything you would ever want to know about a 1040 tax return at your fingertips. And let's just say you have something in your homework or in your life about do I qualify as an exemption for dependents? What are the exceptions? And the qualifying child, what are the exceptions? And here are the exceptions. If you have a qualifying child or qualifying relative, you can claim an exemption for that person only if these 3 tests are met. Dependent, taxpayer test, They have to be a dependent. Joint return test and citizen test, and you just click on each one of these. They link to those particular tests. It's an excellent source of research, and that's a form just for publication 17 is only for individual income taxes for individuals. There's also similar things for the C corporation, for the S corporation, for the trust, for the estates, for everything federal. Similar resources exist for each state that you will do business in. Okay, let's quickly go to 16 more minutes. Okay, I want to make sure I cover certain things. Chapter 2 So we went over the formula for income tax, for individual income tax and the adjusted gross income. And that's a repeat of what we already did. That's a repeat, except it's more detailed. So we talked about itemized deductions, standard deductions, personal exemptions, dependency exemptions, and child credit. We talked about standard deductions, personal exemptions. So child credit. In 2012, since this is that date, it was $1,000 per qualifying child. If they're under 17 and a qualifying child, that's the amount of the credit that you would get off your taxes. The credit reduced if the modified AGI exceeded the threshold. If your modified AGI exceeds the threshold, that means the credit gradually goes away, because there's a sweet spot on how much income you can have. If you make too much income, you can't get the qualifying child tax credit for anybody. The child credit is refundable to the extent of 15% of your taxpayer's earned income in excess of $3,000. Now you're probably going, what? I don't understand. Basically, go to your textbook, read it. Just know that taxes is a rule-based, R-U-L-E, it's a rule-based system. Go find the rule and apply the data to the rule. And that's the way to succeed in this course, and that's the way to succeed if you go into taxes. Find out what the situation is, go to the rule, read the rule, apply the data to the rule, and do the calculations as the rule dictates. Kiddie tax. Children with unearned income. What is unearned income? What income could you get that you didn't earn? Well, a W-2, a paycheck, you earn a paycheck. You actually trade your time and effort for a paycheck. So you have that. So you have no personal exemption. So the children would not be able to have a personal exemptions on their own. Again, unearned income. That would be if someone somehow gifted them money and they put their money into a savings account or an investment account and they got interest or dividends from those investments. That would be unearned. instead of exchanging time for a paycheck. The standard deduction is reduced to the greater of for the kid's tax return, the greater of their earned income. Remember, this is unearned income. So they have a standard deduction equal to their earned income, or if they don't have earned income, it would be greater of $950 as their standard deduction, or their dependent's earned income plus $300. And that's the standard that you apply to a tax return for a child who has unearned income. And it continues. So now we still have the kiddie tax. All kids less than 18 years of age, they have a tax rate on the kid's return, net unearned income in excess of $1,900 will be the same as the parent's rate, if higher than the child's rate. So if the kid has more than $1,900 in unearned income and the person's under 18 years of age, it's the same as the parent's rate. Certain kids aged 18 to 23, that's something that you have to be a little curious about. Well, the certain is if they're 18, it applies if earned income is less than half of the support. So if they're basically on their own, if they're not on their own because they're earning less than half of their support and their unearned income is greater than $950, then this rule applies. If 19 to 23, the same rules for age 18, only if they're also a full-time student. So they're stuck under the kiddie tax rules if these two conditions apply. And parents of a child subject to kiddie tax may elect to include the child's dividend and interest on their own tax return. That makes plenty of sense because that way they don't have to have a multiple tax returns being prepared, and at a certain point the child's taxable income rate is the same as the parents. And they do this if the child's total gross income is less than or equal to $9,500 and all of the child's income is from dividend and interest. Now we're talking the C corporation. Basically, you're talking gross income minus deductions. And at the end of the process of doing the C corporation tax return, you're going to basically be reconciling the income statement of their financial reporting, their actual income statement in their financial statements, to the tax return here. And you can kind of see that there's a parallel. Income minus deductions. Deductions are what? Taxable expenses. That will get you taxable income. What is that? Pre-tax income times the tax rate will get you the total gross taxes. How much did you prepay or have a credit at the IRS? And that's the net tax payable or the refund due. So what you learned in accounting applies to taxation. Again, here's the same corporate tax rates that we discussed earlier. I talked that the flow-through entities do not pay tax at the entry level, and C corporation pays tax at the entry level, and the owners pay tax on corporate earnings, the dividends when received. That was my example of our owning Netflix stock. Capital gains and losses. What is a capital gain or loss? It's when you, other than inventory, trade receivables, self-created work, depreciable business property, business land, and other government publications. So what does that really mean? It means if you have a cherry red Mustang, 1963 Mustang, it's in perfect condition. You bought it for $1,000. You renovated it with your own efforts, and you bought it for $1,000, and you can sell it for $21,000. You just have a capital gain of $20,000 when you did that. So now you have capital gains tax on that. It's not a business income. You didn't go into business to renovate old hot rods. This was a love of yours. If you sell some of your antiques because you want some cash, that would be capital gains. If I had a car and you had a truck and we exchanged it and there was some capital gains in there, then you would have capital gains on that, because we're not in the business. I'm not in the business of selling automobiles. So the capital gains and losses is defined as the other than category. There's long term and there's short term. If you held that asset for over 12 months, it's a long term gain. If you held it for less than 12 months, it's a short term gain. If it's a net short term gain, you're taxed at the rate of other income. If it's a long term gain, it's taxed at the maximum tax rate of 15%. I've had, since the decline of the stock market, I have clients who had a huge capital loss. They couldn't apply the loss against the gains because they had no gains. Because that's how you can use up your capital loss, is to apply it against directly dollar for dollar against your capital gains, and therefore you're happy because you don't have to pay tax on the gains because your loss ate up the gains. But I had a lot of people who didn't have any gains that year, and they had a lot of loss. Whether they're able to carry that loss forward until they can use it up with gains, or deduct $3,000 a year of that loss and use it up slowly over time. So here, individuals can deduct only up to $3,000 of net capital losses from their other income. And unused losses are carried over indefinitely to offset gains in future years. So let's go to the homework that's expected for this week. And let's just show you what it looks like. Again, this is based on 2012. We have Letitia. She's single. And she had the following income and deductions for the tax year. She had salary of $60,000. She had business income. Think Schedule C, $25,000. She had interest from bonds. You have to look up bond interest in your textbook. $10,000, and she had tax-exempt bond interest of $5,000. So she has total income of $100,000. Her business deduction, her deductions, business expenses $9,500. That's related to the $25,000 business income. Itemized deductions $20,000. You saw the itemized deductions. Remember, standard or itemized deductions at decision. So she has itemized deductions of $20,000. Personal exemption of $3,800, giving her total deductions. Part A is compute her taxable income and her federal tax liability for 2012. Remember, you have the 2012 tax tables provided to you under the tab that says your assignment for this week. Part B is to compute her marginal, average, and effective tax rates. For tax planning purposes, which of the three rates in Part B is the most important? So you need to come up with your definition of what these three tax rates are and figure out, for tax planning purposes, which of these are most important. And that's 1-39, Chapter 2-39 is filing status and dependency exemptions and child credit. For the following taxpayers, you have Arnie, Buddy, Cindy, Debbie, and Edith. Which tax form should be used, and the applicable filing status, the number of personal and dependency exemptions available, the number of children who qualify for the child tax credit. So you have to read the filing status, dependency exemptions, and child credit rules in your textbook to be able to work these. Arnie is single, college student. I think he's probably single as far as applicable filing status. Who earned $7,700 working part-time. He had $200 of interest income and received $1,000 of support from his parents. So with that set of data, how would you apply the rules for him? Buddy is a single college student who earns $7,700 working part-time. He had $1,600 of interest income and received $1,000 from support of his parents. So here would be the difference between Arnie had $200, but Buddy had $1,600. There might be a difference between those two. Cindy's divorced, so she's not single, she's divorced. So if she's divorced, you had to look that one up. And received $6,000 of alimony from her former husband and earned $12,000 working as a secretary. She also received $1,800 of child support for her son who lives with her. According to the written agreement, her former husband is entitled to receive the dependency exemption. So this year, the husband gets the dependent for the child, and she isn't able to take it this year. Only one person can take a dependency for a child. Now we have Debbie. She's a widow. She's 68. And she receives a pension of $8,000, a non-taxable Social Security benefits of $8,000, and interest of $4,000, and she has no dependents. And Edith is married, but her husband left her 2 years ago, and she has not seen him since. She supported herself and her daughter, age 6. She paid all of the household expenses. Her income is $16,000 and consisted of a salary of $15,200 and interest of $800. So the question here would be, is she married? She's not single because she's not divorced. Or is she? Question for you to look up. She's married. She might be married filing separate. But you have to look at, is she married or not? You have to figure out divorced or that's going to be an interesting one to research. And then you have one more, which is computation of taxable income. The following information relates to Tom, a single taxpayer, age 18. He has salary, he has interest, and he has an itemized deductions. So compute his taxable income, assuming he is self-supporting. Compute his taxable income, assuming he is a dependent of his parents. And that's your homework for this week. And I think we've been on for over an hour. So remember to utilize the IRS website, utilize your textbook. Your textbook is going to be monumentally important for this course. Use your textbook and actually work these question by question, and have them turned in by midnight Mountain Time Saturday. Until then, I'll talk to you next week.